As always, guys, I always recommend just dollar cost averaging into a broadly diversified index, set it, forget it. But for entertainment purposes and kind of the risk I'm willing to take on in this market, I'm personally trying to do something a little bit different here, more contrarian, more distressed asset type of investing, where I think there's a lot of upside, but there's also a lot of risk as well. Welcome back in, everybody. So in today's video, our account is hitting new highs. And if you're new to the channel, I slowly been building out a small account challenge here. Basically, the thesis of this is really looking at distressed assets, undervalued assets, and assets that I think could have a pretty significant move and that I think are deep value assets. Now, we work on fundamental analysis on this channel and long-term price action, two things that I think are very important when we look at building into positions. So in this video specifically, I want to talk quickly through my portfolio, how I'm going to be taking profits here, and how I'm going to create additional income within my portfolio. On top of that, I want to talk through what is going on with the banks, just touch on retail because I do think the consumer is tapping out. And now, if you're new here, we started with just under $25,000 a year ago, haven't really added any capital to this portfolio, kind of just been picking undervalued stocks, trimming, and then redistributing where I think undervalue is, writing option calls, and doing all of that. We've underperformed over the last 3 months, but as you can see today, with concentration, that's going to be natural. You're going to get underperformance, and then when appreciation comes for your positions, that's when you're going to start seeing outperformance. The 2-year change in this portfolio is not accurate because of the fact it was moved from TD Ameritrade to Schwab, and somehow the account accuracy is just out the window. And even some of my positions, cost basis of my positions are not accurate either. So there's some inaccuracies, but the nice thing is we do have records of basically the beginning of this year. And as you can see here, we just hit a new high within our portfolio. We're up 1.67% on the day, which pushed us over $34,000. My largest position right now is PFIZER. As most of you know, I thought it was a buy around $24, $25. We did a deep analysis on this. We came in right around a $24, $25 price target with downside risk possibly going into the high teens. So this is where I thought it was appropriate to start looking at PFIZER right around $25, $26. We started averaging in, and it's now grown into our largest position. Because of market performance here, now PFIZER knocking on the door of nearly $30 a share, and it also pays over a 6% dividend at those price points. Now, the two core positions I'm obviously making up in this portfolio is going to be Cisco Systems and PFIZER. I want Cisco Systems as my largest position. I really like where the reinvestment. I think the valuation is appropriate. I do think it could go into the high 30s, so I do think there's probably a 20% risk within this stock, but I also like the long-term trajectory of what we're going to need for AI here. They've bought a massive acquisition in Splunk, which is every day looking like a better deal, especially when we look at the acquisition that Google just made. Cybersecurity is becoming more and more prevalent, that we're needing this on a daily basis, and Cisco is positioned extremely well to grow Splunk's revenue within their business model, and they also have invested $1 billion in a fund for AI development. Not only is that the thesis, the true strong thesis I have in Cisco Systems is that there's going to be an upgrade cycle needed in order to really implement AI through business platforms and everyday living. And Cisco Systems has the hardware to update. So I do think that they are positioned extremely well. We bring it down to Warner Brothers Discovery. The valuation here is a high risk, high reward type of stock. Now I got in right around $7 a share. And as you can see here, it is pushing $7.63. We ran a valuation on this one as well. And as you can see here, between $7 and $8, this definitely becomes interesting. A break below 7 is ideally where I thought the value lied for this company for a risk versus reward standpoint. And then our two new positions are going to be Bumble and Zoom Videos. Now, Bumble to me is a very good value here. So Bumble's trading for a PE ratio right around 57 times, but the forward PE is sitting closer to 10, 11 times earnings. Now, the company's trading for under a $2 billion market cap, sitting right around $1.6 to $1.7 billion. I still think they're in the growth phase. I still think the fundamentals are starting to show themselves. And so this is a company that's grown from $760 million now to over $1 billion in revenue with under a $2 billion market cap. So a small market cap here overall. And when we look at the growth phase of Bumble, I still think the assets are very interesting. I think when we're talking about being more reliant on technology, there's going to be a higher demand for human contact. And I think Bumble's positioned extremely well for that. And I think they can actually monetize this much stronger than where they are today. So I think the monetization of the upside here is definitely there. I also think that they've made recent acquisitions that are going to start paying off in the next 3 to 5 years. This one's probably going to be really volatile overall, especially if we go through a market downturn. So I have a very small position in this, but this is one that I started looking at and averaging in around $9.25, which is now going to lead me to my last position, which is Zoom. Zoom to me is very, very interesting here. There's a tremendous amount of people that use the platform. I still think when we look at working from home, relying more on technology, Zoom is positioned uniquely. And when we talk about AI, they are starting to invest more in AI. Now, I'm not buying it for essentially what they've done or where they're valued today. I'm buying it for where I think they're positioned and how clean the balance sheet is. Zoom has a cash position of $7 billion. That means factoring in debt and everything, they have a surplus of $7 billion. The company valuation is sitting at $17 billion. Makes this one very interesting because the cash alone is actually making this stock a reasonable buy. Now we factor in the users that use this platform, how reliant we're becoming on doing more video with the current user base that Zoom has. Where can this spider off to? And that's where I think the unique position is, and that's why I think even if you're buying it today at roughly a forward PE sitting around 12 to maybe 13 times earnings, and a clean balance sheet with the opportunity to still have revenue growth is an interesting position. Now, obviously, these are more speculative, and I think the more stable positions in my portfolio are going to be PFIZER and Cisco, but I would like to add about 5 to 6 other names here, but we're just starting off, so bear with me, and we might be trimming here in the very near future if things start getting a little crazy. So with PFIZER, my largest holding, we do have that reverse head and shoulders pattern that I pointed out, and it looks like we're going to break out through some resistance here, or at least test this resistance. Now, if we do get a breakout, I'm looking at possibly between $30.50 to $31.25 to be the next kind of resistance points for PFIZER. Now, bearing any sort of catalyst, I think this is a position you can collect a dividend and write a covered call on and collect a little bit of extra premium here, really creating some income into your portfolio. And if you're willing to lose a position, as I'm willing to lose about 100 shares of PFIZER and knock my position down from 415, possibly down to 300. This is probably a strategy I'm going to be willing to take here very, very soon, especially if the stock keeps going up. Now, if we look at some of the analysts here, Cantor Fitzgerald's tends to be pretty accurate when it comes to PFIZER and its target of $45 a share, which to me is kind of high here. Now, there's a few things we can look at. Their earnings are expected to be about $2.75 in 2025 and just under $3 in 2026. So here's what I want to do just to kind of reiterate writing a call and where we're kind of willing to take a profit here. So we'll call it $2.75 for 2025. PFIZER historically trades between 13 and 15 times earnings. So if we put a 13 multiple on that, we're looking at a $35.75 stock for 2025. So does it make sense for me to collect a dividend and be willing to sell the stock right around $31 a share? I think the answer is yes, because the stock should have a pullback at some point in time, bearing any crazy catalyst. Now, if we take that same $2.75 and you believe PFIZER is going to have closer to a 15 multiple on it, then you're probably going to want to stand fast and just not do anything and keep watching the stock appreciate and still collect that dividend. I'm a little bit more overweight than most. This is a contrarian portfolio, so it is a high risk portfolio, so I do have to take some chips off the table when the opportunities are presenting themselves because how exposed I am to the risk versus reward curve. I'm a little bit more on the risk side to say the least, but I also think I have a lot of deep value upside opportunity within these names. They're projecting $2.90 roughly for 2026. We put a 13 multiple on that. We're looking at a $37 stock, $2.90 times 15. We're looking at a $43 stock. So, I definitely think we're looking anywhere between a 33 to roughly a 40, call it $43 stock. So a $33 to $43 stock. And if I'm able to collect a dividend and write a covered call against it and get my average closer to $31, $32, then I'm kind of pulling forward some of the gains that are possibly going to come next year. And I can move that capital somewhere else where I think there's a greater opportunity. I just wanted to run through that strategy with people that are maybe looking to take some chips off the table or maybe looking to create a little extra income while collecting that dividend. So I have 415 shares times roughly a 42-cent dividend. So for me, I'm going to be getting $174 in dividends. And, if I collect a premium of roughly an additional 30 cents, that's $30. So I could collect close to $204 right around when the dividend is issued for PFIZER. And there is the opportunity that I would have to sell right around that $31 mark because I could get the position called off. But there is also an opportunity that I collect this money and I'm still holding 415 shares. So that's something you have to look at in your portfolio if you're willing to take some chips off the table. So we're seeing a really, really nice pop in Morgan Stanley because capital markets are looking strong. Then we take it to a Charles Schwab. New brokerage account misses. So this is a growth story. To me, Charles Schwab trades for a pretty substantial premium because of the growth prospect and the unique position of Charles Schwab and the platforms that it has. I'm actually a Charles Schwab customer, really like the platform. I think it's the best platform for being free. And I think you get some of the greatest insight, and it just seems to be getting better and better and better. So to me, this could be a buying opportunity. This might be a stock we dive into. But what I wanted to show you guys is the contrast that's taking place within the market right now. A lot of optimism when it comes to capital markets. And then we see that retail investors are actually slowing down here. There's not as much brokerage accounts being open. Charles Schwab is starting to slow down on the growth. And they're definitely missing in certain areas where we expect them to be growing. And that kind of goes back to a Nike to me. When we think about the consumer kind of slowing down here, well, it looks like the consumer is slowing down in all aspects. Not only is it slowing down on possibly buying those high merchant items, but also looks to be slowing down on investors wanting to put money to work in this market. So is that fear that we are at a top? Is that fear that they don't want to lose what they're invested in? Really hard to say at this point in time, but I would say that this is something that is definitely starting to play out here. When we look at higher end consumer slowing down, we look at retail consumer, we look at retail really taking a nosedive. Those high ticketed items, whether it's coffee or sneakers, really taking a hit. And then we look at a Charles Schwab underperforming, is telling me that something's going on with the consumer as a whole. And it's starting to be the consumer is actually hitting that wall. When we look at debt rising on the consumer, we look at spending slowing down, hours worked coming down, and we also see unemployment is now ticking up. Very, very interesting part of the economic cycle that I wanted to bring to everybody's attention. And here's where I kind of want to draw the line here. It's definitely going to come down to the labor markets, but the quality of labor. So when we look at the jobs being created, most of the jobs being created are going to be healthcare and government jobs. Now, another big part is going to be services. Services could be I sign up to drive Uber. That's a job creation. The problem with that is that's not sustainable. That is not that's not true strong economic growth. True strong economic growth is I open a small business and I hire 5-10 people that are going to be there long term. Those are going to be taxpayers. Those are going to create local economy. Those are going to strengthen local economies. So when we look at more of your signing up for Uber, signing up for Uber Eats, and that's creating jobs and government jobs and healthcare jobs, those are jobs that can be taken away very, very fast and don't have true strong economic cycle withstanding through recessions and withstanding through necessities of life. Those are kind of luxury type things. Having a lot of government jobs is a luxury because of taxpayers. Having Uber Eats and Uber is a luxury. You don't need that stuff. And so if we see that kind of stuff slow down, we can see services take a big hit. We can see government jobs take a big hit. And in turn, we could see the labor market actually dive much faster than we probably ever seen, because I think a lot of these jobs are very questionable. But I find this contrast to be extremely, extremely interesting and actually something to watch. So if you've been watching the channel, guys, I have a price target ideally sitting around 66 to right around $66 for Nike. So less than a 10% decline from these levels. And I think Nike gets really, really interesting. Now, this is going to be a long-term buy and hold, probably going to be very volatile if we do go into a recession, which means you might even be able to get it cheaper than my ideal price target. But this is definitely one I think is starting to get pretty friggin' interesting at these levels. Historically low valuations at these levels, but we don't know what forward earnings are truly going to be with a slowing down consumer. So you never want to jump into those type of value traps. Always run your analysis very conservatively. And so when we get these nice moves, I do think it makes sense to lower the risk by taking some chips off the table, keeping it in cash, and looking for better quality opportunities to build into when they go on sale. As always, guys, appreciate your time, and we will see you in the next one.